Yesterday, silver was left for dead. Today, it's alive. We just witnessed a violent 22% increase in 24 hours. Prices ripped from $65 straight back to $78. But if you blink, you miss it. The mainstream news isn't covering this. They are asleep at the wheel. But the charts aren't sleeping. Trillions of dollars just flooded back into the market overnight. So the big question isn't, why did it go up? The question is, was that the bottom, or is this the ultimate bull trap designed to wipe you out? Let's look at the scoreboard. It's not just silver. Everything is moving. Bitcoin pumped $11,000 in a single day, reclaiming the 70,000 mark. The US stock market added over $1 trillion in value in just 2 hours. Think about that for a second. $1 trillion, the NASDAQ and S&P 500 erased their losses like they never happened. This is a V-shaped recovery. It's fast, it's aggressive, and it tells us one thing: the fear is gone and the greed is back. Now, before we go deeper, I need to be clear about something. I deal in facts, I deal in data, I don't sell hype. There are a lot of copycats out there right now. They scream moon when candles are green and doom when candles are red. They are selling you a narrative to get clicks. They want you emotional. I want you to be educated. I am here to show you the mechanics of the machine, because real markets don't care about your feelings. They care about leverage, liquidity, and supply. Look at the price action over the last 24 hours. Silver bottomed at $65. That was the point of maximum pain. That was where the weak hands folded. Then boom, $78, a 22% move. If you only watch the headlines, you wouldn't even know it happened. But this is happening across every risk asset. Bitcoin dropped 35% over 3 weeks. People panicked. Then, in the same breath, altcoins started rallying. It's the same movie over and over again. They crash it, they flush the leverage, and then they buy it back cheaper. Stop calling it volatility. Call it what it is: manipulation. The news is manipulated, the history is manipulated, but you can't hide the truth forever. We need to talk about the physical market fundamentals. Did the big banks just call the bottom? There is a quote you need to burn into your brain. Corrections don't kill bull markets. Blind consensus does. Right now, professional investors are paying top dollar to borrow silver. The lease rate is 1%. That sounds small, but in the metals world, that is a flashing red siren. It means physical metal is tight. It means nobody wants to let go of their bars. When the price on the screen is fake, the physical metal disappears. We saw a massive flush in the paper markets. Total open interest in gold contracts dropped to levels we haven't seen since 2018. That is a 6-year low. What does that mean in plain English? It means the tourists are gone. The speculators got washed out. They sold their positions at a loss. And history tells us that when the speculators leave, the price usually turns around and rips higher. The lows are very likely already in. But the biggest story is happening in the East. Look at China. Since 2020, they have drained 6,600 tons of silver from their exchanges. That is 90% of their stockpile gone in 6 years. Imagine a swimming pool that is 90% empty. That is where we are. Yesterday alone, they pulled out 73 tons. Do the math. If they keep buying at this rate, and if no new supply comes in, the vaults could be empty in 11 days. 11 days. China is using these price drops to vacuum up every ounce of physical silver they can find. Then you throw gasoline on the fire. Geopolitics. Tensions with Iran are escalating again. The US just announced new sanctions. The talks broke down. Iran refused to let the US save face. When politicians start fighting, smart money runs to safety. Safety is gold. Safety is silver. The geopolitical risk premium is coming back into the market. If you are panicking because the price dipped last week, you are zooming in too close. You need to zoom out. When you look at silver compared to the US money supply, we aren't even close to a top. We just broke out of a historical range from the 1980s. This isn't the end. This is the reload. If you are staring at the daily chart, you are panicking. But if you zoom out to the long-term chart, you realize something simple. This is just a retest. The price broke through a ceiling, and now it is coming back to test that ceiling as a floor. That is normal behavior. We haven't even crossed the highs from 2011 yet. Think about that. Some people are already writing silver's obituary, but the party hasn't even started. You didn't really think this line would go straight up forever, right? That's not how markets work. This is one of the biggest wealth transfers in human history. Big games are never easy. They are designed to shake you out. They are designed to steal your position before the real move happens. But here's where the math gets interesting. This is the millionaire maker trade that almost nobody is talking about. Silver miners. Historically, miners are like a lever. When silver moves 1%, the mining stocks should move 3%. In the bull market from 2002 to 2011, silver rose by about 300%. That's a great return. But the top silver miner, Pan American Silver, it soared 1,500%. That is 5 times the gain of the metal itself. So, look at what happened in 2025. Silver price ripped higher. It went into triple digits. But the miners, they stayed flat. The SIL ETF barely moved. It makes no sense. Why would the company selling the product not go up when the product price triples? The answer is human error. Wall Street analysts are lazy. They are driving the car while looking in the rearview mirror. They were still calculating the value of these companies based on silver being $35 or $40. They haven't updated their spreadsheets. That changes this month. The earnings reports are coming. Imagine a company that pulls silver out of the ground. When silver is $30, they make a little money. When silver is $70, their costs stay the same, but their profit margin explodes. We are talking about producers showing 1,200% more profit than before. Cash is flooding into their bank accounts. You cannot hide that kind of money. The analysts will have no choice. They will have to upgrade the stocks. And when they do, the price catches up fast. It's like holding a beach ball underwater. You can hold it down for a while, but eventually it shoots up into the sky. But there is a bigger problem brewing, a structural break in the system itself. We have spoken about the banks manipulating the price with paper contracts, but Bloomberg just released a report that says the quiet part out loud. Banks do not have infinite money. They have limits. They cannot suppress the price forever if they run out of cash. And right now, they are running out of physical metal. We are staring down the barrel of a crisis at the COMEX. This is the main marketplace where silver is traded. Mark your calendars. We have 21 days. In 3 weeks, 429 million ounces of demand will crash into roughly 100 million ounces of supply. Think of it like a game of musical chairs. There are 400 people playing, but there are only 100 chairs. When the music stops on February 27th, 300 people are going to be left standing with nothing. If the delivery demands match what we saw in January, we are looking at requests for 200 to 300 million ounces of silver. But the vault only has about 100 million. The math is broken. It is physically impossible to fulfill those orders. This is the definition of a default. So, is the path clear for a straight shot to the moon? Not exactly. We have to be honest about the risks. There is a dark cloud hanging over the market, and its name is Bitcoin. Bitcoin acts as the canary in the coal mine. It smells of danger first. And right now, Bitcoin's history is flashing a warning sign. Every major Bitcoin bear market in the last 14 years has been brutal. In 2011, it dropped 93%. In 2015, 84%. In 2018, 83%. The crashes are getting smaller, but they are still massive. The math suggests the next bottom could be around a 70% drop. If that pattern holds, Bitcoin could fall to $38,000. Why does this matter for silver? Because in the short term, markets move together. If Bitcoin crashes, people get scared. When people get scared, they sell everything to get cash. They sell their stocks, they sell their crypto, and yes, they sell their gold and silver. We saw this happen already. Silver bounced by 22% yesterday. Bitcoin reclaimed $70,000. The risk on trade came back violently, but the technical structure of Bitcoin is still shaky. It suggests we might see more volatility before we see new highs. I'm not telling you this to scare you. I am telling you this so you don't panic. Look at the psychology. In mid-December, silver was at $65. Everyone was screaming, buy, buy, buy. The sentiment was euphoric. The RSI indicator was at 80, which means it was overheated. Now look at today. We are back at $65. The price is the same, but the psychology is completely inverted. Everyone is bearish. Everyone is scared. The RSI is at 30, which means it is oversold. Same price, different emotion. When everyone is greedy, you should be fearful. When everyone is fearful, that is usually the time to buy. The market can stay irrational longer than you can stay solvent, but these extreme washouts usually mark the end of the bleeding. The crash happened in 7 days. That is fast. Fast moves down usually lead to fast moves up. The broader bull market is not broken. The engine is just refueling. We need to be very careful right now. Silver bounced off the floor, but we are not out of the woods. A dead cat will bounce if you drop it from high enough. We need to see the price hold this line. We need it to build a foundation. If it can't hold here, that 22% rally was just a trap to get you to buy before the next drop. But when you look under the hood, the engine is screaming exhaustion. The sellers are tired. They are running out of ammo. Look at the open interest in gold. This measures how many paper bets are active in the market. It just hit the lowest level since December 2018. The casino is empty. The tourists have gone home. The speculators who use massive leverage to push the price around, they got wiped out. When the paper market is empty, the physical market takes over, and the physical market is tighter than a drum. We have a situation called backwardation. That is a fancy word for a simple problem. It means people are willing to pay more for silver right now than for silver next month. That should never happen in a healthy market. It only happens when there is a shortage. It happens when people are desperate to get their hands on the metal immediately, and nobody is more desperate than China. Yesterday, the Chinese vaults drained 73 tons of silver in a single day. Let me put that in perspective. If they keep taking metal at that speed, their entire stockpile will be zero in 11 days. 11 days until the cupboard is bare. They are not selling into this crash. They are backing up the truck and loading it up. They are buying the panic. This sets the stage for a collision course in 3 weeks. March 1st is the deadline. We have 21 days. On one side of the ring, you have paper contracts demanding 429 million ounces of silver. On the other side, in the registered vaults, there are only 103 million ounces available. Do the math. There are 4 claims for every 1 ounce of real silver. If the delivery demands in March look anything like they did in January, the COMEX is going to break. If 50% of those people ask for their metal, the vault goes negative. The game of musical chairs stops and there are no chairs left. But you have to balance this against the crypto risk. Bitcoin is the wild card. If Bitcoin follows its historical pattern and drops to $38,000, it will drag everything down with it. Panic is contagious. When people lose money in crypto, they sell their gold and silver to cover the losses. So here's the reality. The physical market is screaming shortage. The paper market is screaming washed out. But the technical charts are screaming danger. This is not a gambling market. This is a strategy market. You are watching a war between unlimited paper money and limited physical resources. The banks have used their balance sheets to suppress the price for decades, but Bloomberg just admitted that those balance sheets have a limit. They are hitting a wall. There is a specific mechanism the banks use to hide these failures. It's a loophole that allows them to swap paper for physical without reporting it to the public. Most people don't even know it exists, but it is the key to understanding why the price hasn't exploded yet. I found the document that explains exactly how this rig works and when it expires. You need to see this to understand the end game. Click here to watch that video, and I'll see you there.